Refinancing risk is rising for emissions-intensive companies. Climate risk is no longer treated as a disclosure issue in Europe. Regulators have directed banks to integrate climate-related exposure into core credit processes, and underwriting standards are evolving accordingly. For emissions-intensive companies, that shift is not theoretical. It is beginning to surface in refinancing conversations. Expanded diligence requests, additional scenario analysis, more scrutiny of asset longevity and capital expenditure plans. None of these changes arrive with a press release. They appear in underwriting models and credit committee reviews. For CFOs approaching maturity walls created during the 2020-2021 low-rate cycle, the risk is not that lenders may eventually price emissions exposure. It is that some already have. Underwriting logic has shifted. For several years, lenders asked broad ESG questions. Those disclosures often lived in sustainability reports, separate from capital markets documentation. That separation is narrowing. Credit committees are now asking, what percentage of revenue is tied to emissions-intensive operations? How are long-lived assets treated under IFRS S2 disclosures? What CapEx is committed to transition plans, and over what timeline? Are reduction targets operationally embedded or offset-dependent? How resilient are cash flows under accelerated regulatory tightening? These are no longer reputational considerations. They are durability questions. Markets are not repricing uniformly, and spreads do not move in unison. But the direction is becoming clearer. Transition credibility is entering risk models. BlackRock's 2025 Global Credit Outlook noted that transition risk is increasingly treated as a direct input into credit assessments for emissions-intensive issuers. The language was measured. The implication was not. The refinancing wall is real. The urgency is structural, not theoretical. More than $1 trillion in U.S. corporate debt is scheduled to mature across 2025 and 2026, much of it issued during the exceptionally low-rate environment of 2020 and 2021. Globally, the maturity wall is larger still. Those issuances were priced under liquidity conditions and risk assumptions that no longer exist. Interest rates are higher. Insurance markets are tighter. Policy visibility is uneven. Infrastructure constraints are more evident. For industrials, chemicals, logistics, heavy manufacturing, and commercial real estate, sectors with visible operational emissions, underwriting now intersects directly with asset longevity and earnings durability. Refinancing is no longer a pure interest rate exercise. It is a risk perception exercise. Sustainability reporting is not a credit strategy. Many companies assume preparedness because they publish robust sustainability disclosures. But sustainability reports are designed for transparency and compliance, not for credit committee modeling. Lenders evaluating refinancing exposure want financial integration. What is the required CapEx to meet stated targets? What return assumptions underpin that spend? How do asset values change under delayed transition scenarios? Where are stranded asset risks most concentrated? How exposed are margins to carbon pricing or regulatory tightening? If those answers are not structured financially, lenders will model them independently. In credit markets, ambiguity rarely benefits the borrower. The lender translation gap companies managing this shift effectively are not rewriting strategy. They are translating it. Finance teams are increasingly running what advisors describe as a lender-focused integration exercise, aligning emissions targets with capital allocation schedules. Stress testing assets under multiple regulatory trajectories, embedding transition assumptions into cash flow forecasts, linking sustainability milestones to operational levers. This is not a new document. It is financial coherence. Where that coherence is missing, pricing differentials tend to emerge quietly, first in diligence duration, then in spread adjustments. The cost of delay. The companies most exposed are not necessarily those with the highest emissions. They are the ones that cannot articulate their exposure in financial terms. In the refinancing cycle ahead, even modest pricing changes compound. Additional basis points affect long-term cost of capital. Extended diligence affects timing and flexibility. Conditional structures affect strategic optionality. None of these shifts arrive dramatically. They appear in term sheets. The question for CFOs. If your debt stack includes maturities in the next 18 months, The relevant question is not whether transition risk matters. It is whether your capital markets narrative reflects how lenders are now underwriting risk. If a credit analyst read your disclosures tomorrow, would they see operational integration or unanswered exposure? In this refinancing cycle, that distinction may determine more than messaging. It may determine price. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.